What terminal rate do you see in this cycle?
I think it's early to know, but I'm expecting the summary of economic projections in December to come out a bit higher than the last meeting. And I'm also expecting, based on my own forecast, that inflation will be a little bit more persistent than what they're expecting, and labor markets are going to remain a little too tight to get to their objective of a 2% inflation over the next 3 years, which would be a way of saying I think they're probably going to have to be a bit higher than what they're likely to be anticipating coming out of the December meeting.
Would you put a number on it? 5%?
Yeah, a little bit higher than 5%, more like 5.5% would be my expectations. And that assumes that there's enough slowing down in the labor market that you really start getting nominal wages to come down. So if you look at the employment cost index, which is the best measure of wage growth in the United States, it's running at 5.2%. And if you want to get to 2% inflation, something more consistent with that would be in a 3.5% nominal wage. It's really hard to bring nominal wages down that quickly if you have a really tight labor market. And arguably, I mean, right now, 3.7% is below what they think full employment is. And you really see it in the United States. So you go into a restaurant, they don't have enough waiters. You go into a hotel, they don't have enough people to clean the room. You go to a retailer and they're short staff. So labor markets are very tight, and I think those are very consistent with the other labor market indicators we see.
You know, it's a tough environment to be a central banker when you're tightening interest rates. And you know, people often forget that the trade-off to bring inflation back to target is usually a softer labor market. So you need unemployment rate to rise in that circumstance. Do you think central bankers are doing a good job at explaining to the public why that unemployment rate needs to rise to bring inflation back to target again? Are the trade-offs being communicated clearly enough?
Trade-offs are very difficult to explain to people. Everybody wants inflation to come down, but nobody wants to become unemployed to do that. Yeah. And so I think we are in a period where central banks across the developed world are going to have those challenges. And even within central banks, how much weight you put on getting inflation down versus how much unemployment you want to go up. Right now, the committee out of the September SEP was assuming a 4.4% unemployment rate. I think that's optimistic, actually, on what the trade-off will be. So trade-off discussions are quite difficult, and so far in the United States, they haven't really had to address that because the labor markets have been tight, inflation's been very high, so there really hasn't been a trade-off, which has made it easy to do 75 basis point increases. But as we get into next year, you're going to see a softer economy. You're probably going to see inflation that's still well above the 2% inflation target. That becomes a much more difficult discussion, both within the central bank, but also more generally.
It's interesting what you just said now about the 4.4% unemployment rate target. You think that that's too optimistic.
Not a target, that was their forecast.
Forecast, apologies, of course, forecast. What do you think it could get to? And I guess, you know, to accompany that question is, do you forecast a U.S. recession?
Yeah, I think it's quite likely that the U.S. has a mild recession next year. So what do I mean by mild? Unemployment rate more than 5 to 5.5%, I think is probably more likely. I think they basically are going to need that to get the wage growth down to be consistent with the 2% inflation rate they need.